You open your brokerage app. Gold is sitting at $4,400 per ounce. You bought in at $2,800 back in 2023, thinking you were late to the party. Now you're up 57%, and every financial pundit on television is telling you to take profits, lock in the gains, be smart. But here's what they're not telling you. The move that just happened isn't the finale, it's the warm-up act. Because when a sitting head of state gets extracted by foreign military forces and flown to a detention center in Brooklyn, and when the world's central banks are hoarding physical gold at rates not seen since the 1970s, and when the paper claims on gold are stretched so thin that major banks are taking delivery instead of rolling contracts, you're not watching a bubble. You're watching the opening act of a monetary regime change that will make 2025 look like a practice run. My name is Alex, and for the past 8 years, I've been obsessed with one question: what happens when the world stops trusting the reserve currency? Not in theory, not in some economics textbook, but in practice, when central bank governors and sovereign wealth fund managers wake up at 3 in the morning asking themselves if their treasury holdings could be frozen tomorrow. That question became very real on January 3, 2025, and the gold market has been pricing in the answer ever since. If you're trying to understand why gold just posted its strongest yearly performance since 1979, or why institutions that laughed at gold bugs for decades are now scrambling for physical metal, make sure to hit that subscribe button. This video breaks down the market structure that's pushing gold toward $5,000, and by the end, you'll understand exactly why the gap between paper claims and physical delivery is about to become the most important dynamic in financial markets. Here's what everyone missed about 2025. Gold didn't rally because of inflation. Inflation was actually moderating through most of the year. It didn't rally because of dollar weakness. The dollar index was relatively stable. Gold rallied 65% from 2,600 to over 4,300 because the fundamental assumption underlying global reserve management got challenged in a way it hasn't been since Bretton Woods collapsed in 1971. That assumption is simple. Sovereign reserves held in dollars and dollar-denominated assets are politically neutral and operationally secure. January 3, 2025 shattered that assumption. When United States military forces extracted Venezuelan President Nicolás Maduro from Caracas and transported him to a federal detention facility in Brooklyn, the world's reserve managers watched a sitting head of state get removed from power by a foreign military and immediately placed into that nation's judicial system. Now, whether you think that action was justified or not is irrelevant to the market psychology that followed. What matters is the question that every central bank governor asked themselves the next morning: if a head of state can be extracted like that, what exactly prevents my country's treasury holdings from being frozen or seized if we fall out of political favor? That question doesn't get asked in public. It gets asked in closed-door meetings between finance ministers and central bank boards. It gets asked by sovereign wealth fund managers in Abu Dhabi and Singapore and Beijing. And the answer they're arriving at is showing up in the delivery data on the ComEx, in the custody patterns reported by the World Gold Council, and in the largest institutional flows into gold ETFs in history. Let's talk about what actually happened in the gold market in 2025, because the rally everyone's talking about is only part of the story. Gold started the year at $2,600. By March, it hit $3,000. By June, $3,400. September brought $4,000. And by late December, gold touched $4,500 before pulling back to $4,400. That's a gain of 65% in 12 months. For context, gold's average annual return over the past 50 years is around 7 to 8%. This wasn't normal price appreciation. This was revaluation. But here's where it gets interesting. While gold was making those moves, every traditional model said it should be falling. Real interest rates were positive. The Fed wasn't cutting rates aggressively until late in the year. Equity markets were strong through Q2 and Q3. There was no acute crisis, no bank failures, no currency collapse. The textbook reasons for gold to rally weren't present. Yet gold outperformed every major asset class in Q3 by an average of 35%. That tells you something fundamental shifted in how institutional money views gold's role in a portfolio. The World Gold Council's 2025 survey of central banks showed the strongest intention to continue buying gold since the survey began in 2019. Over 1,000 tons of gold were accumulated by central banks in each of the last 3 years, 2022 through 2024. But 2025 was different. It wasn't just the volume, it was the urgency. 59% of central banks now report holding their gold reserves domestically instead of at traditional custody locations like the New York Fed or the Bank of England. That's a massive shift. For decades, keeping gold in New York or London was standard practice. It was convenient for trading and settlement. The fact that central banks are now physically repatriating metal and paying the cost and logistics involved tells you they're pricing in custody risk. They're asking, what happens if access to my gold becomes conditional on my government's political relationship with the United States or the United Kingdom? Now, I know what you're thinking. This sounds like conspiracy theory territory. Central banks repatriating gold because they're worried about seizure? But this isn't speculation. This is documented behavior. Germany repatriated 300 tons of gold from New York and Paris between 2013 and 2017. The Netherlands brought 122 tons home in 2014. Austria repatriated 80 tons. These weren't fringe nations. These were NATO allies with stable relationships with the US. If they felt the need to physically control their reserves, what do you think reserve managers in countries with more complicated geopolitical positions are thinking right now? What I'm about to show you next is the thing that took me months of digging through ComEx data to fully understand, and it's the mechanical reason why gold is headed to 5,000 regardless of what the Fed does with rates. The ComEx is the primary futures exchange for gold trading in the United States. Most gold futures contracts never result in physical delivery. Historically, less than 1% of open interest gets delivered. Traders roll their positions forward, settle in cash, or close out before expiration. That's how the system is designed to work. It allows for price discovery and hedging without the friction of moving physical metal around. But something changed in 2020 through 2021, and it accelerated dramatically in 2025. December 2025 saw 37,003 contracts delivered on the ComEx. That's equivalent to 115.1 tons of physical gold. The delivery rate hit 6.8% of open interest. That's nearly 7 times the historical baseline that prevailed for decades. Now, 1 month could be an anomaly. But this wasn't 1 month. Delivery rates have been elevated since 2020. What changed? Why are contract holders suddenly demanding physical metal instead of rolling or settling in cash? The answer is in the counterparty risk premium. When you hold a futures contract, you have a claim on gold, but that claim is only as good as the financial system's ability to honor it. In a stable monetary environment with deep trust in the clearing system, that's fine. But when central banks are repatriating physical gold, when heads of state are being extracted by foreign militaries, when the implicit guarantee that dollar-based claims are sacrosanct gets questioned, suddenly that paper claim looks a lot less secure than the physical metal. Here's where it gets even more interesting. Registered warehouse inventory on the ComEx dropped 25% from March 2025's peak of 13.5 million ounces to just 10.1 million ounces by year-end. Registered inventory is the gold that's available for delivery against futures contracts. It's sitting in ComEx-approved warehouses, and it's specifically designated as deliverable. When that number drops while delivery rates are spiking, you're watching a supply compression in real time. And it's not retail buyers driving this. Wells Fargo's proprietary trading desk absorbed 42,900 ounces in a single December settlement. Morgan Stanley accumulated 44,000 ounces in parallel. These are sophisticated financial institutions with access to every corner of the gold market. They could buy allocated gold in London, they could buy through Swiss refiners, they could source metal a dozen different ways, but they're choosing to take delivery on ComEx contracts. That tells you they're positioning for a scenario where physical gold becomes harder to source, or where the spread between paper claims and physical metal widens dramatically. This is exactly what happened in 2008 during the financial crisis, except with one critical difference. In 2008, central banks were net sellers of gold. They were liquidating reserves to raise dollars-for-dollar swap lines and to stabilize their banking systems. In 2025, central banks are net buyers. They're accumulating. That means the natural shock absorber that existed in 2008, the ability for bullion banks to source metal from central bank sales, doesn't exist anymore. When stress hits this market, there's no relief valve. The ETF flows confirm this isn't a fringe narrative. Global gold ETF inflows hit $57.1 billion in 2025. Total assets under management in gold ETFs pushed toward $445 billion. US-listed funds alone attracted $32.7 billion. SPDR Gold Shares, ticker GLD, logged its largest single-day inflow ever in September 2025 at $2.2 billion. The three biggest daily inflows in GLD's 21-year history all occurred this year. Let that sink in. The biggest institutional allocations into the largest gold ETF in the world all happened in the same 12-month period. This isn't retail panic buying. Retail doesn't move $2 billion into a single fund in one day. This is pension funds, endowments, and sovereign wealth funds shifting their strategic allocation targets. For decades, institutional portfolios held 2 to 3% in gold as a hedge. That was the conventional wisdom. Enough to provide some insurance, not enough to drag on returns if gold underperformed. But in 2025, you're seeing allocations shift to 5 to 7% targets. That rebalancing takes quarters to complete. Institutions don't just flip a switch and dump 5% of a billion-dollar portfolio into gold overnight. They scale in, they dollar cost average, they build positions over time. Which means the flows that drove gold from 2,600 to 4,400 are nowhere near finished. Now we're halfway through this breakdown, and if you're still with me, you're already ahead of 90% of investors who looked at gold at 4,400 and assumed they missed it. But the best part is still coming, because we need to talk about what happens when the paper market breaks. Gold trades in two primary forms, physical and paper. Physical gold is bars, coins, allocated metal sitting in vaults. Paper gold is futures contracts, unallocated accounts, ETFs that hold physical but allow for redemption, and various derivative instruments. For decades, the paper market was larger and more liquid than the physical market. That's fine as long as trust holds. But when trust erodes, people start asking, how many paper claims exist for every ounce of physical metal? The exact number is disputed, but estimates range from 40 to 100 paper claims per ounce of deliverable gold. Think about what that means. If even 5 to 10% of paper holders decided they wanted physical delivery, the system couldn't honor those claims without a massive repricing of gold to pull metal out of jewelry fabrication, private hoards, and other non-investment sources. In late 2025, gold futures started trading in backwardation. That's a technical term that means spot prices, or near-term futures prices, are higher than longer-dated futures. In a normal commodity market, you expect contango, where future prices are higher because of storage costs and financing costs. Backwardation means there's a premium for immediate physical delivery over future delivery. It means the market is pricing in scarcity or delivery stress. It's the market's way of saying, I want the gold now, not a promise of gold later. Backwardation has appeared in gold markets before, usually during acute stress. It appeared in 2008. It appeared briefly in March 2020 during the COVID crisis. But in 2025, it persisted. It wasn't a 2-week anomaly. It was a structural feature of the market for months. That's a flashing red signal that the relationship between paper and physical is under strain. Hungary's Prime Minister Viktor Orban made an interesting comment in early January 2025, right after the Maduro extraction. He called Venezuela's oil reserves, the largest in the world, good news for Hungary's energy security. On the surface, that's a weird statement. Hungary doesn't import Venezuelan oil. But read between the lines, Orban was signaling that with Maduro out, Venezuela's reserves were no longer under the control of a government hostile to Western interests. That means those reserves could come back online, which means global oil supply improves, which means one less geopolitical pressure point for Europe. But here's what's relevant for gold. Orban's government has been one of the most aggressive accumulators of gold reserves in Europe. Hungary's central bank tripled its gold holdings in 2021 and has continued buying since. When a leader known for accumulating gold makes geopolitical statements tied to resource security, you're seeing the linkage between commodity reserves, geopolitical stability, and monetary reserves in real time. The Federal Reserve's policy adds another layer to this. In December 2024, the Fed announced it would resume purchasing $40 billion per month in Treasury securities. That's quantitative easing by another name. Whether they call it QE or balance sheet management or liquidity provision, the effect is the same. The Fed is expanding its balance sheet by buying treasuries, which injects liquidity into the system. Now, the stated reason was to prevent disruption in treasury markets and ensure smooth functioning of repo markets. But the effect is that the Fed is monetizing debt. It's buying government bonds with newly created reserves. And every time that happens, the implicit debasement of the currency makes hard assets like gold more attractive. The January 27 to 28 Fed meeting is critical because the market is pricing in potential rate cuts as early as Q1 2026, and any dovish signal from the Fed will accelerate gold's move. If the Fed signals that inflation is under control enough to justify cuts, or if growth weakens enough that they need to ease, gold will react immediately. Not because rate cuts are inherently bullish for gold, but because rate cuts in the current environment signal that the Fed is prioritizing financial stability and employment over currency strength. And when the Fed prioritizes financial stability over currency strength, gold wins. Bank of America published a $5,000 price target for gold in late 2025. That wasn't a speculative moonshot. That was based on modeling supply and demand dynamics, ETF flows, central bank buying, and the trajectory of real interest rates. $5,000 represents roughly a 14% move from current levels of 4,400. In the context of a 65% rally that already happened, 14% seems almost conservative. But here's why it matters. Bank of America's commodities research team is one of the most respected on the street. When they publish a $5,000 target, institutional buyers who need third-party research to justify allocation decisions now have cover to increase exposure. Let me tie all of this together, because when you see how these pieces connect, the path to 5,000 becomes obvious. Central banks are buying gold and repatriating it because they're pricing in custody risk and political risk on dollar reserves. That demand is structural, not cyclical. It's not going away. Institutions are rebalancing portfolios from 2 to 3% gold to 5 to 7%, and that flow takes quarters to complete. Meanwhile, the ComEx delivery mechanism is under stress. Registered inventory is dropping while delivery rates are spiking. The spread between paper claims and physical metal is compressing. Backwardation is signaling delivery premiums. And the Federal Reserve is expanding its balance sheet while the world's reserve currency faces questions about political neutrality that haven't been asked in 50 years. This isn't like 2011 when gold hit 1900 and then collapsed because the euro crisis stabilized and QE ended. This isn't like 2020 when gold hit 2000 and stalled because vaccines rolled out and the crisis passed. This is a structural repricing of gold's role in the global monetary system. When a sitting president gets extracted by foreign military and the world's central banks respond by accelerating gold accumulation and repatriation, that's not a crisis trade. That's a regime change trade. The real question isn't whether gold hits 5,000. The real question is whether 5,000 is the top or just another milestone on the way to a complete reset of how sovereign wealth is stored. Because if you're a reserve manager in a country that's not a Tier 1 US ally, and you just watched what happened to Maduro, and you're sitting on $200 billion in treasury holdings, what's your move? You can't dump treasuries overnight without crashing your own portfolio and causing a diplomatic incident. But you can slowly diversify. You can buy gold. You can repatriate it. You can build a reserve buffer that doesn't depend on another country's legal system or military deciding you're still a friend. That's the trade that's happening right now. It's not loud, it's not dramatic, it's just persistent. And it's showing up in ComEx delivery data, in ETF flows, in World Gold Council surveys, and in the price chart that keeps making new all-time highs every quarter. Whether you're holding physical gold through this volatility, trading futures contracts around Fed meetings, or positioning through mining equities, the opportunity isn't about timing the perfect entry. Newmont gained 160% in 2025. Barrick gained 181%. Those moves already happened. But the structural drivers that caused those moves are still accelerating. The compression between paper and physical is still building. The central bank bid is still there. The institutional rebalancing is still in progress. 4,400 isn't the top. It's the consolidation level before the next leg higher. So here's what happens next. If gold holds 4,400 through Q1 2026, and if the Fed delivers even one rate cut, and if central bank buying continues at current pace, the path to 5,000 is measured in months, not years. And if delivery stress on the ComEx intensifies, if registered inventory keeps dropping while delivery rates stay elevated, you could see a violent squeeze where the spread between paper and physical blows out and forces a rapid repricing. That's the scenario where gold doesn't grind to 5,000. It gaps to 5,000 overnight as bullion banks scramble to cover short positions with physical metal that's increasingly hard to source. The boulder isn't on your shoulders anymore. For years, gold bugs pushed that boulder uphill, arguing for gold while the Fed printed and markets ignored them. But something changed. The boulder crested the hill. Now it's rolling downhill, picking up speed, and the only question is whether you're positioned in front of it or behind it. Because when reserve currency trust erodes, when paper claims exceed physical metal by 50 to 1, and when central banks choose physical possession over custodial convenience, you're not watching a bull market. You're watching a monetary system reprice itself in real time. The next 6 months will define whether you positioned for the regime that's ending or the one that's beginning. The Maduro extraction on January 3rd wasn't just geopolitics. It was the moment when every reserve manager on Earth recalculated the risk of holding sovereign wealth in someone else's jurisdiction, and they're recalculating by buying gold. The market's telling you exactly what's coming. The only question is whether you're listening. What's the next market move you want me to break down? Rate cuts, treasury market stress, mining equity plays, or something else entirely? Drop it in the comments, because this is just getting started.